everyone, welcome to the second episode of Frenemies. My name is Camille and today we have two financial advisors with us, Alvin as well as Beverly. So Alvin, can you introduce yourself?
Hi, I'm Alvin. I'm from iFAST Global Markets.
Hi, I'm Beverly. I'm from Frenemies Advisory.
Today's episode will be quite an exciting one as we delve deep into handling the differences between unit trust as well as ETF. Let's start off with some basic terms. So for our listeners who might be new to investing, what is a unit trust, Beverly?
Unit trusts are a basket of professionally managed products which the fund manager selects the companies based on the mandate of the unit trust.
Alvin, can you explain what is an ETF?
ETF is not much different from unit trust. It's also a pool of investments that the fund manager manages. The key difference is that for unit trust, usually it's like over the counter, which means it's not publicly traded. Whereas for ETFs, they are listed on the stock exchanges where you can buy and sell these funds as per how you buy and sell stocks. So it becomes more convenient and more liquid. Whereas for unit trust, they don't go through the exchange, right? So it's settled over the counter.
So now that we've understand more, so I think something that is very crucial for investors to understand are the differences in the cost of their investment. So maybe Alvin, could you share with us, since unit trusts are generally more expensive than ETFs, what are these costs going towards, and do you ever think that it's justified?
ETFs are always seen as cheaper alternatives, and one reason is because majority of them are passively tracked, which means they usually follow an index and the fund manager don't really make a decision what to buy or sell, right? They just blindly follow what the index says. If the index kick out a stock, they will sell the stock. Index adds a stock, they will add a stock according to the weightage. So with that, they don't need a very huge research team, where that means that the cost of the having a staffing, right, will reduce tremendously. So because of this simple structure, that allows ETFs to charge a much lower expense ratio. Right? Whereas on the other hand, unit trusts, they tend to be more actively managed, which means they do need boots on the ground, they do need research, and all this will increase the cost of managing the fund. Therefore, the expense ratio cannot unlikely to be as low as a passively tracked fund.
I think ETF and unit trust both have their space in their client's portfolio. So a unit trust actually aims to outperform the index that is tracking. If the fund manager has a certain view on a certain sector, can increase the weightage of certain sector, or they think that the market is going to turn either way, they can reduce the weightage, etc. They can do currency hedging as well. So these are some of the services that the fund manager can provide to the investors. Other services the fund manager can provide is market outlook. So for a new investor who may be unsure how the market is going for the next 6 months or 1 year, the fund manager can actually provide some market updates. And this can allay some of the concerns or some fears that the new investor may have.
So there are definitely devils in the details in terms of the comparison. Another aspect is that unit trust can come with a Sing dollar hedge, for example. Whereas in the ETF space, there is very few that are hedged. So for some investors who don't want the forex risk at all, right, but they want to invest say overseas, and unit trust may provide this kind of currency hedging options that is available for them to choose. Whereas ETF, they are unlikely to have this option. So there could be a lot of all these minor details. But that's where the job of the advisor to find a suitable investment, right? Whether it's a unit trust or ETF.
So speaking about the details that you're speaking of, maybe on to the next question. So since we all know that ETFs are cheaper, so is there any hidden costs to all this cheapness for the ETF?
I wouldn't say there is like hidden costs, but one of the things that investors have accept is going to be a market return, right? Because especially it's a passively tracked investment, it's not going to be the index, right? It's just going to get what the market return is going to be. So some investors, they may feel that I believe that I want some outperformance, then a lot of all these passively managed ETFs may not be suitable, right? That's where the active management comes in. But of course, when it comes to active management, it's also no guarantee that you will outperform, right? So if you outperform, there's also a chance that you underperform, and there will be more variability in that returns. So I guess the hidden cost is that you have to accept that you're not going to beat the market. You're just going to take whatever the market gives you, less of the expense.
I think the cost for ETFs and unit trusts are both reasonable. Yeah, as compared to other investment vehicles like hedge funds, kind of cost structure is very different. So it really depends on how comfortable is the investor is. If let's say they prefer something that's very widely diversified and according according to the market fluctuation, then ETFs will be very suitable. But if they feel that the fund manager can provide an outperformance in terms of beating the index net of the fees, then unit trust is a good option to consider as well.
So maybe just throw you a curveball question. So how do you know, or when do you know that fund manager can have the potential to outperform? Are there some factors that you consider when you choose those funds for your clients?
Historical returns is not indicative of future returns, but success also leaves clues. So usually when a person is able, or fund manager is the one that's selecting the stock which forms part of the unit trust, if there's a track record of him or her being able to outperform the index which the fund is tracking, that shows that the fund manager has expertise. And that makes sense for the investor to go with this fund if they are able to have a sustained track record of beating the index that they are tracking.
Given that ETFs are more cost-effective options, so are there any similar options that investors can look at in the space for unit trusts?
Increasingly, there are also unit trusts that are passively managed. Right? That means unit trust that tracks a particular index. And on the other hand, there are also ETFs that are becoming more active. So it becomes very blurred nowadays whether an ETF is passive or active, or a unit trust is passive or active. So I guess the more important thing is, again, look at the expense ratio, right? And compare to the underlying strategy that you're actually getting, right? Whether is it worth it. And it's not really about unit trust versus ETF. I think now the debate is about active versus passive. Right? It can be in a form of unit trust, it can be a form of ETFs. So there are nowadays a very low-cost unit trust that tracks the index as well.
I think also another topic that is quite relevant to Singaporean investors will be on the aspect of a CPF. So in general, when they invest using their CPFs, do they invest in unit trusts or do they invest in ETFs?
They can invest in both ETFs and unit trusts, right? But definitely the universe of unit trusts for CPF investment is a lot larger, right? A lot more wider, because it has a longer history, right? ETFs is a much shorter history. The approved ETF list is, what I understand, is a lot shorter. Definitely in the unit trust space, there's a lot more options to look at when you want to invest your CPF.
For CPF approved unit trust, there's many selection criteria. There's many funds to select from. There's also bonds that we can go into that has in the past 2 to 3 years outperformed the CPF OA. And there's also global equities that can give both the returns as well as the dividends that investors can consider looking at if they are looking for sources of income.
So on the next part, then we'll compare the performance of unit trusts versus ETFs. So how do they compare? Maybe we start off with Bevan.
So let's say we have this unit trust and it's tracking a particular index. There are unit trusts that outperform the index, i.e. the ETF and the index. There are unit trusts that underperform the ETF and index. So we aim to select one that has that suits our mandate, the overall portfolio mandate, and has consistently outperformed the index that is tracking.
ETF can be more volatile than unit trust and vice versa. It's not really the instrument, but rather the underlying assets that the ETF or the unit trust are having. So for example, if it's a 100% tech focused ETF, it's going to be very volatile, right? Same as if it's again a tech focused unit trust that actively pick tech stocks, that will also be volatile, right? But if it's a bond ETF or a bond unit trust, then the volatility will also be lower. So I do think that it's the underlying assets that's important, right? Not so much of whether it's a unit trust or ETF.
So in that case, then what role do fund managers play in terms of managing the fund during market volatility?
It depends on how their mandate is, right? How much of their assets can go to cash, for example, for safety. But usually for ETFs or unit trusts, the mandate is to invest majority of the money, right? And not keep them in cash. That's not what they are designed to do, or the objective. Unless you're talking about hedge fund manager, then that's totally different story. They are known to hedge against such volatility, and hence the name hedge funds. But for unit trusts and ETFs, they're usually long only. Can't expect the managers to manage the volatility. So that falls in the responsibility of the advisors. Right? How do you manage the whole portfolio volatility? If the client is not so comfortable with volatility, then maybe you need to really have a shorter term bonds, a bigger proportion inside to make sure that the whole portfolio doesn't fluctuate too much. So I would say that it's not the fund manager's job, but rather the advisor's job to handle the volatility. Another aspect is also the client's emotional aspect, right? That's also the advisor's job to assuage them the fears that they may have about volatility, right? Partly education as well. So fund managers probably really will just stick to really the mandate. This is what I'm set out to do, right? Yeah, and whoever invests, I will just invest accordingly. So it's the advisor's job really to handle the volatility.
As advisor meets the client, we speak to clients about their risk appetite, so their risk profile. So if they are a bit more adventurous, we'll gravitate more towards the aggressive portfolio where there are more equities and less bonds. So to add on what Alvin has said, right? If let's say the client is less risk averse, we'll go towards a more balanced or even conservative portfolio, where then there will be more bonds and less equity. So the volatility will be very much based on the asset allocation. And then within the fund itself, what the fund manager can do to reduce the volatility, assuming it's a global mandate fund, they can actually switch from, let's say, a tech weightage to something more defensive, such as consumer staples or like health science, healthcare.
Even for this volatility, it's interesting because this is the golden question. We want to find out, right, a client risk appetite. We run through all the questionnaires and things like that. The funny thing is that sometimes the clients may not exactly know their own risk appetite. Right? Some may overestimate themselves. Say, I can take volatility, and then suddenly the stock market dropped 20%. They start to get worried, right? Then you, as an advisor, you start to know that okay, they cannot take this level, right? So you need to tune the portfolio more conservatively. Right? And some may underestimate their risk tolerance, which is rarer. Right? Usually they overestimate. Some would like, oh, I want safe investments. I don't want to lose too much. But then the downside of safe investment is that the returns tend to be lower. Right? Then they will complain, hey, how come my returns is so low, right? Yeah. So it's the job of the advisors to really find out. Right? Because even the investor or the client themselves do not really know what their risk appetite is. That's my experience. I have to really fine-tune with them as time goes by.
That's true. So at the underlying basis, the client should have this understanding, or the advisor should have this understanding with the client that the higher the risk you're able to withstand, the more rewards you can gain over the long run.
Traditionally, the UTs will have a higher investment cost to start off with. So as a person that might only have a few hundreds to invest in a month, so does it mean that I cannot really invest into a diversified portfolio?
Everyone starts small, assuming we are not trust fund babies, Yeah. So unit trust starts at $100 a month. So I think it's very reachable for all new investors or for everyone. And also because if we're using iFAST as a platform, there is no lock-in period. So let's say if there's any missed periods of collection, there's also no penalty, at least from iFAST side, to the investor. So let's say we're only talking about $100 per month, we can go to a diversified global equity.
And even ETFs, you can invest in few $100. I think times have changed. Investment has been made a lot more affordable compared to the past, right? Even for ETFs, the lot size has reduced. You can buy one unit. You don't need to buy like minimum 1,000 units. Same for unit trust, right? You can buy minimum amount, and you can even buy in fractions depending on the amount that you really want to invest in. iFAST has a lot of money investment plans that people can build their portfolio over a long period of time.
So let me give you guys a case. Let's say your client comes to you and say that they have a pool of $10,000 to invest. So what would you recommend for them to invest in? Maybe Alvin, you can take this question first.
I think definitely the first thing that we need to do is the risk assessment to see how much risk the person can take and versus the investment objective that they want. At times, it can be very mismatched, right? Of course, everybody wants, I don't want to lose money, I want to make 100% return. Right? That kind of very mismatched, non-market rate kind of return risk profile. And then we need to educate them. That's not possible. If you want to get, say, this X percentage, you need to take potentially Y percentage down, right? There could be a trade-off that when it comes to that. So it's about finding that, help them fact find where that level of realistic investment returns you can get versus the risk that they are taking. Right? So after We have finished. Okay, so this is the particular risk profile, and I think advisory firms are pretty standard. Then you decide how much the allocations to bonds and stocks are going to be. Then let's say it's a classic 60-40 portfolio. That means 60% to stocks, 40% to bonds. Then you talk about the building parts. Right? Are you going to build with ETFs? Are you going to build with unit trusts? What options are you going to give to this client? Right? So for example, my preference would be for stocks. Usually I'll use ETFs, right? Because they're a lot more cost efficient. And for the bond segment, I'll usually use unit trusts, right? Because unit trusts for fixed income or bonds, they tend to do better than passive. Right? There's a higher chance that they can beat the index. But for stocks, usually it's harder. Right? I think because of the efficiency of the market, stocks are publicly traded, so it's very hard to find alpha. Right? Whereas bonds are not so liquid. Bond managers do add more alpha to the equation. So then I will pick from the pool and then form a portfolio.
Maybe Beverly, you can also walk us through your process of how you invest with your clients.
So the first thing to ask is, what is the time horizon? Does this individual need the fund for any liquid, for any purpose? So for example, if the person needs the fund for renovation, that's very different because they need it probably in the short term. Then these monies are perhaps best to put in the most liquid format and low risk. So assuming the investor is looking for something longer term, then next will be the risk profile. Walking through the client, what is their risk appetite based on simulated portfolios? How does the person react if, let's say, the portfolio drops by 20% when we go in? The third one is liquidity, cash flow. Does the person need dividends? So assuming the person does not need dividends, and after ascertaining the risk profile, so let's say it's aggressive, because Alvin has touched on balanced portfolios, so I'll just go to aggressive portfolio. So aggressive portfolio typically is 80-20. Yeah, 80-20. So then we decide on what is the allocation for the equity portion, and then allocate the rest to bonds.
So if you were to give advice to someone who is just starting out on their investment journey, so what is one advice that you give them?
For me, I think start as soon as possible, right? Because a lot of people procrastinate, especially when people hear about retirement planning, that I'm still young, why should I think about retirement so far away? But if you flip it around, you don't want to think about retirement the next day you are going to retire, right? Because you'll be too late. You don't have that horizon to grow the money, and you might not have saved enough as well, right? So I would think that one good advice is just start as soon as possible. Don't worry about whether the market is going to go up or go down. Right? Nobody can predict for sure. But if your investment horizon is going to be long, right, say 10 years, 20 years, any correction or any crashes will just look like a blip in the entire span of the history.
So it's very important to start as early as possible and start as much as possible based on your own comfort level. Yeah, especially in your 20s, this is a period where likely you're single and there's nobody to spend your monies for you. So that's when you should go a little bit harder on savings. That will help to build up your resources very fast. One very important part about investment, I think we all can agree, is the power of compounding. Compounding is very powerful in terms of driving those returns, and you really need the time horizon to have the monies run up to your retirement age. So the answer will be as much as possible to your comfort level, and also be reasonable in accepting the fluctuation. So with that said, it will be good to keep a buffer of monies in cash stash, right? So that whenever you feel the market is going a little bit volatile, you can actually withdraw from that cash stash if needed.
Study, SPIVA, right, where it's shown that for majority of the actively stock managed funds, right, they don't beat the index. Over say a span of 5 years, more than 70% don't beat the index. So I would say that if someone wants to start with some stock investment, maybe a money investment plan, ETF would be a better bet, right, for a passive investment kind of arrangement. But if let's say if it's a fixed income, right, or bonds, the data is like more than half don't beat the index, right? But you can see the difference is about 20%. So there's still a higher chance that you can get a bond fund that will beat the index. So I would say that if someone wants to have a bond component, then maybe a money investment plan into a bond fund, bond unit trust would make more sense, right? So it could be a mix of both.
Okay, for me, I think I'll emphasize on the compounding. So I think it's very important to start early and as much as possible. So it very much depends on the attitude of the investor. So if the investor is someone who prefers a more passive approach and would prefer not to meet the advisor for a period of time, and ETF could be a good way to actually compound the returns because ETF tracks the indexes. If a client is more active in meeting the advisor in terms of their yearly review, I would recommend unit trust as one of the ways because we can actually look for unit trusts that can outperform the ETFs. Yeah. As for bonds, I think it's a very good way for people to park their monies, lump sum cash monies, to get them more returns as compared to like placing the monies in the bank.
Thank you for tuning in to the second episode of our Frenemies series as we compare between unit trusts as well as ETFs. So here I'd like to thank our advisors who are Beverly and Elvin for their active discussion today on the topic. So thank you everyone for watching. Bye bye.